Oh yeah. Just once. Oh yeah. All right. Hopefully you guys can hear us online. It's 10:10. In true accounting form, I like to be prompt. So we're going to get started. This is the FASB update, accounting update. Again, if you are looking for GASB, so our public institutions, you'll want to go find that separate link and join the separate Zoom meeting. Okay, well, good morning again. My name is Megan. My name is Megan Crane, Associate Director of Assurance out of Lexington. I'll be helping, me and Brittany today will be going through all the FASB updates. And so let's get started. All right. We do have polling questions in our presentation today. So again, you put 22333 in the to line. So where you would put mom, dad, sister, brother, babysitter, whatever it is. And then you would enter Dean Dorton in the message. You can also use the internet if you prefer that. All right, our objectives today. Of course, we have to have objectives in order for you to get CPE credit. So we're going to discuss current trends, go over the FASB pipeline, and then dive into some actual accounting standards. All right, first part, current trends. I think these trends have kind of been around for, we'll call them the post-COVID era. So trends pre-COVID were very different than trends now. But the biggest trends we're seeing in accounting and finance, again, are working remotely, technology, not just technology. Of course, there's tons of new software you can use. I'm sure you guys all receive in your inbox every day. Have you thought about this? I can help you with this. Let me use this new solution for you, so on and so forth. But in this case, we're talking about using technology, giving issues hiring employees. So how are you employing maybe tools you already have potentially to take less human hours? So the data analytics, those types of technologies. Outsourcing and co-sourcing, in Kentucky, we have a big pension issue in the public universities. But, even your private institutions, how are you working smarter, not harder, given the difficulty of finding employees? I think if we had a polling question, we'd say, how hard is it to get employees? When I talk to clients, they say, we used to get 50 to 100 resumes every job we posted. And now they're getting 5 or 10. And it's not a testament to that institution, still a great institution, but there's just more competition out there, and higher ed maybe isn't the most, well, sometimes the headlines are hard, right? They don't help the industry. And so that's not helping. Data analytics, again, talked about that a little bit under technology, and then ESG metrics. I think we'll start to see those come into play as students become more interested in ESG measures, but those are the current trends as of today. All right, first polling question. So 222-22-333 into the 2 line. And then here's the question. So which trend do you think has or will have the largest impact on higher education? We'll give everybody a minute here to respond. Oh, these are going all over the place. Every time, it's like when you're popping a bag of popcorn and you're like waiting for the last kernel, to pop. That's how I feel like. You try to wait for these to settle a little bit and then they keep moving. All right, so these are kind of settling. So working remotely, of course, I think that's a trend we're seeing not just in higher education, but across the United States, across the world. But what I think is interesting about higher education is that you will have to have some people on campus. You do. You serve students. You are, at the end of the day, you boil it all down to nothing. You guys are a service industry for students. And so how are you serving those people? Yes, they might not want a ton of interaction. And so maybe you can push some things behind a computer screen, so on and so forth. But at the end of the day, you've got to figure out, how do you make it work? Is it hybrid? Is it not hybrid? Is it a day on campus, not a day on campus? But also when you're coming into the battle for, employees, some schools that we were talking this morning, like you might be in a prime area, like the Raleigh area. Sure, you want to be in higher education, you've got lots of options here. We know small towns out in the state that maybe it might be harder to attract people to come work there. So how are you dealing with that? Maybe working remotely helps you. And then again, I do think, so every time we've asked this ESG, given that question, I think the percentage has gone up. So I do think that that's coming more front of mind kind of as we go forward. I personally think data analytics that number will also continue to go up as you're talking to start thinking about, okay, how are we transitioning, an aging potential workforce at higher education? I mean, there's nothing more valuable to an institution than someone who's been there 20, 30 years, but how are you replacing that knowledge 20, 30 years, and what processes can you improve when they leave? I think data analytics is a nice opportunity there to maybe take some manual processes they might do and make them a little smarter, more efficient, not smarter. Here's the FASB projects that are coming up. If you want some light reading, you can go to FASB.org and see all of these. But talking about recognition and measurement of certain items, including cryptocurrencies, software development costs, again, environmental credits, stock compensation, hedge accounting, tax structures, and joint ventures. That's all in the area of recognition and measurement, where they're working to figure out, okay, what guidance do we need to provide on these to actually recognize them in financial statements? There are some potential presentation and disclosure items coming. Income statement expenses, that's mainly going to apply to public entities, not public universities, public entities. And then segment reporting. And then every time, which I think this is what we all do, you implement a big project and then you take a step back and you say, okay, what did we do well, not do well? What do we need changes on? So they are doing post-implementation reviews on CECL, revenue, and leases. The post-implementation review on leases was maybe a little premature because we aren't done with it yet. But they are looking at, again, those SEC companies that have implemented that and saying, okay, what needs to change? All right, so here's where the ASU trends have gone. Of course, we had a lot in 16, a lot in 18, and then we have slowly declined year over year because what did they do? They smacked us in the face with revenue, and then they smacked us the other way with leases. And they decided, okay, you guys can have a little bit of a break here. And so you see that trend kind of downward. They're going to want to keep their jobs, so I expect at some point that trend will go back up. But luckily, we're kind of getting on the backside of these things. We have a fairly normal year as far as standards go. Only a couple have been released in 2023. We are going to talk about one a little bit later. All right, so where are we? ASC 606 revenue should be done and in the bag. It's in steady state. So you're just analyzing it year over year to see if there's anything you need to change. Great. Leases. I'm tired of talking about leases. I give this presentation, I think, almost every year. I also do it at our fall accounting and ethics update. Been talking about leases a long time. You guys are our last group to get leases in. And so we'll call it nearing completion and moving to steady state, which will be nice. CECL is coming, so current expected credit losses on receivables. Not a huge impact on most entities, but something you will have to analyze. That's coming for 2024. Brittany's going to talk about it ever so slightly later. And then there are other ASUs out there. They're what we'll call the fairly easy to implement. Maybe don't hit a ton of people, but there are other ones out there. So don't sit here and say, well, Megan didn't say anything else. We're covering the high level stuff here. Leases. All right, everybody, deep breath. Okay, so ASC 842 leases. We've been talking about it for a long time, long time. Okay, 531 year ends. You've got like a week left. 630, you've got 5 weeks left. So where do you stand in the process of adopting 842? I'm almost scared to get these results, I'll be honest. Okay, so A is monitoring our ongoing steady state, B is in the final stages, and C is getting started. This is why I was a little anxious, I think, this morning about this. Fewer C's, please. Okay. Oh, man. All right. Great. If you're an A, that means you're done. Awesome. Monitoring steady state. We love to see it. You might be a foundation or some related entity. Maybe you have a different year end than most of our college and universities, or you adopted early, which is good on you. If you're in the final stages, I'm feeling good about you. Okay, good. We've got, again, a week or 5 weeks left to wrap that up. Hopefully, if you're on the Dean Dorton audit client, we're going to start looking at all your lease work at interim. So if you're not done yet, it's coming. We're coming very soon. Okay, if you're in the getting started group, Maybe you're like an 8/31 year end. It makes me feel a little bit better. If not, like the time is now. We need to get going. Even if you say, I have none, period, that is not enough for an auditor to stand on. So we need to see some work around I have none. Oh, okay. If you're in C and you haven't started, give me a call. We'll help you. No, but seriously, get to work on it, because what you're not going to want to do is come August, we're talking about an October board meeting, field work's going on, all the things. And we're like, hey, where are you on leases? And you're like, well, I need to write a 3-page memo about what we've done around it. No one wants to do that. No one wants to do it, period. No one definitely wants to do it in August. So go ahead and get that going. And then maybe like in the next week, you could be moving to letter B. All right. All right, let's take a flashback. So before 842, there was 840. So 840 walked, so 842 could run, which 840 was just an agreement conveying the use of property, plant, or equipment, usually for a stated period of time. So what changed under 842? 842 became a contract, or part of a contract, not even the whole contract, just a portion of it, that conveys the right to control the use of an identified property, plant, or equipment, or another asset, for a period of time in exchange for consideration being potentially money. But so the difference there is that you could have embedded leases, which is that part of a contract. So you pay a service fee to use phones. Well, then you have a physical asset, a phone. And so technically you are leasing. Your service contract, part of it is a lease. And then it's the right to control. So even though you may have a physical asset, like a water cooler maybe, that you lease, you pay a monthly subscription fee for. The lease agreement might say, yeah, but we can come in and we can replace this water at any time. We can give you a blue bottle, a green bottle, a pink bottle. It doesn't matter. You have no control over what this actually is. That's not a lease in the new case. So, but you have to do an analysis based upon every contract you have. All right, so presentation of your financial statements. If you have the statement of financial position, AKA the balance sheet, for finance leases, formerly known as capital leases, now you have a right of use asset and a lease liability. Same thing with operating leases. You have a right of use asset and a lease liability. Pretty easy. Statement of activities. I do think it, side note there, your finance leases may or can still be included within PP&E if you want. You'll still have that lease liability. Operating leases would probably be its own line. Statement of activities, again, your income statement, you have amortization under finance leases, amortization of the right of use asset and interest expense. As opposed to operating leases, there's just one single lease cost on there. You don't have to break it out into the two different ones. Statement of cash flows for operating, you have interest expense on the finance leases, and operating leases are all cash payments, so that's easy. And then in the financing activities, again, you have your capital finance lease recorded down there, the principal payment, so you can see the declining balance, and then no impact from operating leases. There is a package of practical expedients out there, related to short-term leases, non-lease components, and discount rates. I encourage you to look at those and see if they apply to you. We're going to briefly talk about the two at the bottom, which are in yellow, including related party leases and then a transition package that's available. All right, related party leases. They should be recognized on the based upon legally enforceable terms and conditions and should follow the same guidance as recognition for leases with unrelated parties. Pretty easy. However, if both parties have the right to terminate the lease without their permission from the other party and without penalty, then it may not be legally enforceable and you might not have to record it. So again, it's all about how the lease agreements are structured. So you can't just say, we have this asset, we have a lease, okay, but it's not material, we don't care, blah, blah. You've got to do some analysis on each individual contract. So keep that in mind if you do have any related party leases. The package of 3 transition methods say that you don't have to reassess lease classification based upon implementation date. So if it was a capital lease before, it's a finance lease now. You don't have to go back and redo the analysis. You can just keep them where they are. And then no need to go back and look at initial direct cost based upon the implementation date, and no need to restate prior years. So you're gonna have some big adjustment potentially at the beginning. Your cash flow is gonna have this big disclosure on the bottom of it that says, we added $45 million worth of assets and liabilities. Again, it just grosses everything up. All right, so what are some lessons that we've learned from implementation so far? Again, we've been through this, at least as an accounting firm for several years. And so these are some lessons that we've learned. Lease versus non-lease components. So again, those embedded leases. So something you may pay a service fee for that includes a physical asset. You have to analyze all those contracts. Lease term, what options and clauses to include or exclude? So let's say you have a long-term lease, because short-term leases aren't included here. You have a long-term lease that you're going to lease for 5 years for sure. And then you have 2 5-year renewal options. If you're likely to stay in that for the next 10 years, those need to be included in the calculation of the lease liability on the date of implementation. If you don't know for sure, think about the other things around it. So like, if you're renting a house building just off of campus, and you guys have, maybe it's a business building, you've put a lot of work into it, you've done fit up, blah, 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 all the things, you've done all this thing, you've stamped your name on it, but you're renting it. Well, what's the likelihood that you're going to up and move out after 5 years? Maybe not much. So again, think about, okay, yes, even though we want to say, oh, we are not taking those renewal options. Economically, you look at it, you say, okay, you've spent all this money. You probably are. So think about it that way. You do have an option to use the risk-free rate for private companies, and you can apply that at the class of assets. So you can use the risk-free rate on equipment and something different on property. Again, lease payments and the discount rate, are they fixed payments? Are they fixed in substance? Are they variable based upon an index or rate, or are they variable based upon something other than an index or rate? So think about all those things as you're going through those. All of those impact your actual lease payments and your calculation of your liability. And again, if you had a capital lease before, the new finance lease doesn't say, here are the 4 tests you have to perform, but everybody's pretty much using those 4 tests to say, yes, this is a new finance lease. Let's chat briefly about de minimis level. This is conversations I know we've had with clients across the board about different things, but there is no de minimis level in GAAP. There is an IFRS, which is the international standards of $5,000. So what you need to do is prove out to your auditor why you feel like your de minimis level is appropriate. And why is this important? Well, if you said, hey, we could have 100 $1,000 leases, I mean, materiality works in my favor. You technically don't have materiality. I have materiality that I can say, okay, yes, I agree. If you recorded all 1,000 of those $100 leases, none of it would matter. But you need to prove to me that you really only have 100 of them. And so just something to think about how you're going to prove that out to your auditor. Here's the analysis. Here's the list we've done. Here's our natural break where it doesn't mean is a pain in the patootie anymore to record all these leases. So this is what we've called de minimis. That includes all assets under $1,000, $5,000, et cetera. And this is what our policy is going to be. Have a written policy. We'll test it. We'll look at it, make sure we agree with you. That being said, I was at a conference a couple of weeks ago, and the University of Texas was doing a FASB session, which is a little different, but same thing. Their threshold was $100,000 for leases. So that's probably not going to apply to every small private institution or even large institution we have on the FASB side, but something to think about the numbers that people are using there. And I think that was actually approved at their state level to say, okay, all public institutions will use $100,000. All right, so if you've gotten this, somebody jumped ahead. If you've gotten to the point where you've said, okay, I'm going to use, we've done our analysis, here's our whole list of leases, this is the threshold we're going to use, this is going to be our policy going forward, what are you using? I should have given more options than some other amount. I should have said 5 to 10, 10 to 20. That's all right. Okay. Unsure? Unsure is a great opportunity for you. Think about, what you're probably the ones that answered C earlier that haven't started. I'm just kidding. But something that you can think about and saying, okay, yeah, we hadn't thought about using a threshold for leases, but we've got our analysis started. Let's go ahead. Let's use a threshold. Let's look at it. Some other amount, I hope it's higher. I hope it's not lower, for your benefit. And then 5,000, we actually have seen quite a few people use 5,000. That's the capitalization threshold for their fixed assets in general. So that's what we're seeing a lot of people use. All right, this is my 2023 standard I would like to talk about. It's called common control arrangements. This is basically for any private companies or not-for-profits that don't have conduit debt obligors. And basically what it is that if you have a written agreement for common control, I'm not sure this is going to apply too much at higher education, but it could, because if I said it's definitely not going to apply, like 10 of you would be like, oh, we have that. We have this weird thing with, this entity that we control that it's written. Anyway, somebody would be like, what? I can't believe you didn't tell me about this. So here you go. And this might be good for your board members to understand too, because they might have other places they sit on. Anyway, so in order for this issue to apply, it has to be written lease terms. Okay, so it has to be in writing. Preferably not on the back of a napkin, but like an actual document would be helpful. You have to determine the lease based upon the written terms, and then the classification and accounting of a lease is based upon written terms. Of course, common control is when someone controls both. So in the for-profit world, what we're seeing is an owner owns a building. They also own portion of the company. Company pays rent to the owner to use the building. Common control. In this instance, you're going to amortize anything economic life-wise to the life of the common control group, not to the lease term. So if you say, hey, we have a 1-year lease that's renewable annually, that's not what you're applying. You're applying it overall. You can early adopt it. As far as transition, there's 2 options here. Again, you're basically, if you haven't adopted 842, you're going to apply your same transition method you do there. If you have adopted 842, you'll follow this other one. All right, I'm gonna let Brittany take it over from here.
Lovely. Thanks, Megan. All right, so contributed non-financial assets. This in theory, so this is a new ASU, should have been adopted for fiscal years beginning after June 15th, 2021. So our June 30 institutions should be implemented as of 6/30/2022, but hopefully we can provide some tips and tricks and some maybe helpful insights as you move forward and looking and adopting this. So contributed non-financial assets. Contributions obviously is a big key in not-for-profit institutions. And so this is just essentially providing a little more transparency and those contributions that aren't monetary. So 2 ways in which you can approach in disclosing it on the financial statements. So you can disclose it as typically right now, probably on the face of your financial statements, there's a line item that just says contributions. Can involve various things. Now it needs to be broken down by contributions of cash, and then another line item of contribution of non-financial assets. You can go a step further on the face of your financial statements, and it might say contribution of building, contribution of vehicle, and then contribution of cash. But regardless of which approach you take on the financial statements, on the face of the financial statements, you're going to have to go a step further in the disclosures of the financial statements, and we'll talk about that. So non-financial assets, land, PPE, inventory, food, you get the gist. So what is the most memorable non-financial asset you have received? So homes, some art. Our universities in Kentucky might get a horse. We've talked about that, A condo. Cars. Okay. Is that what it said? Oh yeah, it says a resort. I'll join that team. Selling some horses. All right. Interesting. I was just curious to see what kind of non-financial assets you guys were receiving. All right, so I briefly mentioned regardless of how in detail you break it down on the face of the financial statements, you're going to have to go into some further detail in the footnotes of your financials with the disclosures. So these have some bullet points in what you're going to need to show in those footnote disclosures. Qualitative information about whether that contributed non-financial asset, was that liquidated or was it utilized within the university with a certain program? So did you get a building and then you turned around and sold it? Did you get a building and then you turned around and used it for admin offices? So that information will need to be disclosed in the footnote. The not-for-profits policy, if any, that you have about liquidating or monetizing that contributed non-financial asset, rather than utilizing it. So maybe it's a time to step back and talk with your development office and kind of internally management to see, do we have a policy for that? We might need to start looking at one. Because that is something that's going to need to be disclosed within the financials. A description of any donor imposed restrictions. So with any other donor restriction contributions that you receive for non-financial contribution assets, you're going to want to disclose whether or not it does have donor restrictions on it. You're going to disclose the fair value of the asset that you received. So the fair value measurement that you used to arrive at that fair value amount. And then if it's something that was received with a donor restriction, you're going to have to provide some information on the principal market or the most advantageous market and what you use to arrive at the fair value of that asset. So these next couple of slides are just some example disclosures. This first one we briefly talked about, very straightforward and easy. You no longer have a single line item for contributions. You now have one that says, here's our cash, here's our stuff other than cash. And then we break it down further in our disclosures. Further in the, maybe let's say in your footnotes of your financials, they say you can disclose this in like a narrative form or a table form. They also say that a table form is probably easier to read and the most transparent to the reader of the financial statements. So how it's broken down here on the left of the table of the like categories of the non-financial assets that were contributed. A question is, well, what categories do I use? That's up to you. It's based upon your judgment and the operations of your institution. So a college might say, okay, we have building, vehicles, food. If you look at a food pantry, they might break it down by canned goods, vegetables. So it's kind of dependent upon your judgment and operations. They do allow, we all love a good miscellaneous account. They do allow a other category as a catch-all for kind of other small items. And then here on the right, I won't read through that, but just kind of going through those bullet points that we touched on a couple slides ago as far as how they assess the fair value. Were there any donor restrictions? This is a further example of the disclosures for 3 of those non-financial assets that were contributed and how they were utilized. So they did turn around and utilize them during the year. And so you'll see in that third column, they have to disclose what it was utilized for. And then the last column is noting what valuation technique they used, like a similar market and real estate for the building. Just a couple key points to consider. Similar to leases, you can use materiality, so kind of assess that. Consider reviewing your gift acceptance policy. So maybe you get in touch with your development office and determine that threshold, that materiality threshold, so that they're aware if a non-financial asset comes through their doors, you know, if it's above this threshold, we're going to need some additional information, and we're tracking that. You could also use separate GL accounts for those non-financial assets. So at the end of the year, it's much easier to kind of run those reports and easier for people to populate those disclosures. So a couple key points just to consider as you start working through these. I'm going to briefly touch on this ASU 2016-13. You might also hear it called CECL, current expected credit losses. And basically just that second point, based on historical experience, current conditions, and key point here, reasonable and supportable forecasts, you're determining whether there's a probable cause of an expected loss on a financial asset. And that being said, if there is, then we're gonna have to disclose that and recognize that. And that will be applicable for fiscal years beginning after December 15th, 2022. So I know Megan mentioned earlier, might not affect a lot of you, but it's something to keep an eye out on as you enter your next fiscal year. Any questions? Great. I think we have a break. All right, 10-minute break. Great. Thank you, guys.